Yeah. And maybe, if 60/40 is kind of what your financial advisor puts the average retail investor in, then maybe the institutional version of that is risk parity, right? Which is the strategy that Dalio kind of pioneered at Bridgewater. I mean, that seems to be kind of the risk, right? In this new regime of secular inflation, that a lot of positioning, whether it be kind of 60/40 on the retail side or risk parity on the institutional side, is going to have to shift. So if this correlation breaks down and actually reverses, right, what does the unwinding of that all kind of look like? I mean, how much turbulence should we be expecting from that?
Yeah, no, it's a great question. And I think most of the turbulence will be on the 40 side, not on the 60 side, right? I mean, obviously, we're seeing turbulence on the 60 side, and the 40 side directly impacts the 60 because of the cost of capital relationship that we talked about at the beginning. But, the 60 most of the time is a good store of value, right? Equities are compounding assets. You compound the cash flows, the dividends, the gains. And so historically, equities are a proven store of value, even in an inflationary period, not in a, I don't want to even say hyperinflation because it's not what we have at all. But even in a period of high inflation, they're not so great because the PE gets so derated that no matter how good the earnings are, no one wants to pay for them. But most of the time, the equity side is okay. So you can tweak it. Like I said, the S&P is large cap growth heavy, right? The FANG stocks. So maybe you deviate away from that more towards the value side, the stuff that is a little bit more inflation protected, because the FANGs and other mega cap growth stocks are very sensitive to changes in the discount rate in the DCF, because they are long duration stocks where investors are paying a premium for a very, very long stream of earnings well into the future. So obviously the cost of capital in that DCF model, if that goes up, it disproportionately affects those stocks more so than an energy stock, which has, of course, much better pricing power. So I think tweaking the 60 towards a more inflation-proof, side, I think is relatively easy to do. It certainly would require some active management, which I think, obviously is fine. But if you look at the 40 side, you look at the flows over the past 15 years since the financial crisis, or 14 years, equities took in over the last 14 years, maybe $500 billion, which in a context of a $40 trillion market cap is not very much, right? I mean, that doesn't include companies buying back their stock, which was much bigger number than that. But I'm talking about investor flows here, mutual funds, ETFs, et cetera. But on the bond side, flows were about $3.5 trillion, and that's on a market cap of I think it's 28 trillion or something. So a much bigger number. And that money is now starting to leave, as you would imagine, right? When yields are going up. And I think that's kind of a similar type of story as what we're seeing in risk parity. When you look at when you look at the correlations of different players in the market to both the changing equity prices and changing bond yields, clearly risk parity was the most levered or correlated to both of those, right? Like CTAs, not so much. Obviously, equity funds are to the equity side, not to the bond side. Bond funds the other way. But the risk parity style was really caught in the crosshairs, and the risk parity tends to have a levered position in bonds, right? Because they need to offset the equity risk by having by creating a larger bond position than they would have in the cash market. And my guess is, I don't have any direct evidence of this, but my guess is over the past 6 months or so that probably that's been where the greatest reset has had to be. But the bigger question is, if bond funds are going to see an exodus of even a part of that $3.5 trillion, and part of that will be lost just from market pricing, right? But part of it could be lost by just investors actually reversing their purchases and buying something else. Then you have to wonder where they would go. Maybe they go into equities. Maybe this actually benefits the equity side, and we go to a 70-30 paradigm instead of a 60-40. Who knows?
Right. So I guess maybe you're in, because I know we've got limited time here, just to wrap this up. what's the actionable takeaway for investors here, right? I mean, there have been very few segments of the market. There are very few bright pockets of the market, right? I guess energy is one that's been talked about recently because there's been structural underinvestment there. But we even talked about some of the traditional hedges that people talk about, right, in these sorts of times are gold, right? So gold, despite it being above where it should be, I guess, based on tips, is still basically trading sideways, which is honestly much better than what everything else in the market is doing. Bitcoin is taking a hammering right now. I think you're definitely seeing less calls about it being an inflation hedge, certainly. But if you had and maybe the greatest irony of this the focus on in an environment of secular inflation, the best thing to own is cash, right? So I guess if you just had parting advice for investors who are listening to the show, looking for a place of relative safety, what should we be looking at here? Is it commodities? Is it pockets within the stock market? Is it gold? Is it Bitcoin? I mean, what's your kind of takeaway?
Yeah, so maybe we go to the commodity supercycle chart. So if we're in a structural inflationary regime, which at this point is not a controversial statement to make, then you want to think about your strategic allocation. So first of all, both stock and bond markets are down. Super painful for the 60-40 paradigm, but also an opportunity to maybe rebalance, right? So if you have a 401k, the stock market is down more than the bond market. So maybe if you haven't done anything to your portfolio, you actually are now underallocated to stocks relative to bonds. So an opportunity to at some point rebalance back to your target, whether that's 60-40 or 50-50 or 70-30 or what have you. And then just to look under the hood about places that are that companies that have pricing power, which of course in an inflationary environment is important. Here's the commodity supercycle. So the top panel shows the S&P relative to the CRB, which is one of the commodity indices. It's not my favorite, but it has the longest history. And the bottom panel is the 10-year compound annual growth rate, or CAGR, of that ratio. And you can see you can see that there's a meaningful long-term cycle. It used to be called the Kondratiev wave. We don't really call it that anymore, but you can see a super cycle spanning several decades, and the rate of change was only at the peak of that range a year ago, and so it seems that there is still time in that cycle. Now, commodities are not the easiest thing to invest in. You have all kinds of roll yield issues if you're in a futures fund or ETF. They're very volatile, so it's not I wouldn't buy too much of it. But this is one port in the storm, if you will. I think gold, the fact that it's holding in so much more than what the models are suggesting, tells me that something is afoot. And maybe it's a future of financial repression that's driving that. And I think Bitcoin at some point will kind of ride that tide as well. And you had a chart of the utility sector that you went through. And that's another area, is just defensive equities, right? Utilities have a low beta. They're boring as hell, but they have a low beta. They have a very good dividend yield of more than 3%, and you add in earnings growth to that, you get something significantly better than that. And they are a port in the storm when earnings growth, which is holding up, but clearly that could be another shoe to drop if it were to drop. So that would be an area maybe to hide in. And it's not just utilities, but consumer staples, maybe even some REITs or things like that. Stuff that is less correlated with the overall beta of the market, and that has a low beta and a higher dividend. And like there's an index called the low vol high dividend index in the S&P that has a yield of over 5%, I believe. So there are places to hide. That doesn't mean they're not going to go down, but they may go down less than the overall index. And after that, I think what we need is just patience. This is a difficult macro environment. But timing the market is really, really hard, right? It may be relatively easy to sell at the top because you see something before others do, but then you have to get back in at the bottom. And we saw, for instance, during the pandemic, how quickly the market reversed itself. And I'm not expecting a repeat of that, but we can see how quickly it can happen. Even after the 2018 decline, all those 20% of losses were recovered within a month or two. So it's really, even if it's easy to get out, it's hard to get in on time because you could easily leave 10, 20% on the table before you even know what's going on. And so, market timing is a tricky business. Even professionals like myself, I don't really do it. If I have some extra cash, maybe I start committing it when it's down at these levels, but it's a tough thing to do. So I would rather tweak beneath the surface of the 60-40 and to make sure that I have the right building blocks, not only tactically or cyclically, but strategically. And I think that's probably the best thing that most of us can do in this market.
So what you're saying is market timing is actually difficult, especially around periods of times like this. Jurrien, as always, this has been a really, really interesting conversation. Guys, as you can see, I think Jurrien, in addition to being the best dressed guy in both macro and crypto, puts together a lot of great charts, a lot of great information. Jurrien, if folks want to follow you, find out more information about the work you do, what's the best way to do that?
Easiest way is to @Timur Fidelity on Twitter.